And welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread, and today I'm joined by my dear friend and colleague, Mr. Chris Stewart. How are you, brother?
I'm doing great. How are you?
Buddy, I am too blessed to be depressed on this beautiful Friday. Now, did you guys get any of the rain up there in Boston this last little bit?
We had huge thunderstorms last night. The dog came running upstairs. So we're going to get some more tonight, too.
I bet. So I'm noticing my screen today. So for those of you who don't watch us on YouTube, we do have a YouTube channel, Financially Simple, and we're working with some audio engineers and some sound engineers, and it is broken. And I look like today, Chris, that I have like this white, very crazy white glare on me. I mean, it looks like maybe that's angelic. What do you think? That can work?
I thought you had one of those, glamour lights on you so you look better.
No, that's not it at all. Actually, this last weekend, my wife and I, we took some time off on Friday and Saturday. It was her birthday. So we went up to the cabins in the mountains, and we got this little cabin with a swimming pool, Chris, and I fell asleep in the chair, and she let me sleep. Well, then I got sunburn, as you can tell from my shiny lobster-looking face, and needless to say, now everybody's picking on me, and I think they came in here and I think they adjusted the lights, so it looks like I'm have this aura about me. You're not sunburnt, so I guess that Boston hasn't had that heat index come out there yet. So let's dive into this conversation today. So we've titled today's episode, "How Should Business Owners Adjust Their Plans, Given the Dangers of the 4% Rule?" And I think we have to lay that out. So let me kind of start unpacking this, Chris, and then we'll get into the technical side. So, you and I in the firm, our colleagues here in the firm, we work with business owners of every age, race, nationality, every type of business out there. Most of us are in the service business. That's kind of where we find our niche.
Yep.
And when working with business owners, there are several statistics that all of us keep in mind that kind of drive our ethos or our core values in the company. And that is that most of our business owners, 80% of their net worth is tied up in their business. And knowing that statistically, only about 12% of businesses actually sell. And in that matter, only 4% of businesses actually sell for what the business owner thinks they're worth. It gets really interesting whenever you and I are doing planning, along with, Brandon, Chris, and Matt, and Jeff, and all the others of the team here. But whenever we're doing planning for business owners nationally, we come to the point at some point where there is a triggering event. There's this event where a sale takes place, or there's an event where ultimately they leave their business. Now, whether that's in where they position their business for like an annuitization strategy, or if they position their business for a full liquidation where they've sold it to somebody else. In fact, we have a couple of clients, as you're aware of, that are working with us at this point. So ultimately, we planners are trying to figure out the navigation of what their life looks like in 5 years, 10 years, 15 years, 100 years, whatever it may be. And so we're having to run assumptions saying that if you continue down this trajectory, you're going to have X dollars. And then when we have X dollars and now you have to start living off those dollars, we have to figure out how long that money's going to last. And now enters in this old methodology. It's been around for many, many, many years, called the 4% rule. Chris, what is the 4% rule?
Right. So the 4% rule, back in around 1995, one researcher came up with a great idea and say, let me go back and look at all this historical data going back to the Great Depression and see what someone could have safely taken out of a portfolio year after year. If they lived for 30 years, what could they take out, inflation adjusted, and not run out of money? So that's what the 4% rule was. So from 1927 through, I forget when the study ended, it came out in 94, I believe. They said there's no 33-year period where you would have run out of money. So that's a very conservative thing, right? It's saying you retire on the eve of the worst market in history, 28, 29, and you still don't run out of money, inflation adjusted. That's a pretty powerful thing.
So you've said inflation adjusted now twice, and I think I need to hone in on what does that mean?
Right, exactly. So, that means that you can keep your spending up in real terms. If you buy a car every 3 years, you can still buy a car every 3 years. You can go out to dinner, you can go on vacation. It goes up with the CPI. So remember, even 2 or 3% inflation significantly erodes your buying power over 20, 30 years. So we want to make sure that we're able to maintain our standard of living throughout retirement.
And so basically, if we withdraw 4% of that portfolio, this particular study done back in the mid 90s said that there was no period in a 33-year time period where 4% basically caused the account value, which provides us the income in retirement, to go away.
Correct.
Am I hearing that right?
Yep.
Okay.
And
I
in the
have
worst
some
case scenario, when you started your retirement in 1929, probably the check to the undertaker failed, bounced.
Well, so, part of my mind, Chris, you and I could play what ifs all day long, but part of my mind says I have yet to meet an average client.
Yeah.
There's always things that every person has. I think of my father, for example. He had a disabling event whenever he was in his late 50s. And if we were trying to figure out a 33 or 30-year period of distribution, I took a 4% rule. I'm sitting here saying, he worked his whole life, blood, sweat, and tears to reach this point, saving up enough dollars, and he's probably not going to live 30 years. In fact, he didn't live 30 years. He passed away in his early 60s. And so, health for some people may say, you know what, take this 4% rule and throw it out the window. I'm just going to live on the funds that I have now. And if that's a 15% distribution rate or 20% distribution rate, so be it. That's one extreme in the conversation that you and I would have to navigate. Another one is the opposite, is that, I was talking with a client yesterday whose mother still is alive at 108 years old.
Wow.
And here we are with an individual who is in their early 70s and spry as can be. This individual and her husband are out playing racquetball on a regular basis, and now pickleball, I think is what they call it.
Yeah.
Pickleball on a regular basis. And you would look at them from the outside and say, man, this family's in their mid 50s, and here they are in their early 70s. And so on their position, had we retired, which they did, by the way, they retired almost 15 years ago. We've been working with them for that long of a period. We were sitting here saying, you're talking about maybe a 40-year distribution rate. A 40-year distribution rate out of this portfolio. So I think we need to make note here that the assumption was based on a 30-year period. My question becomes is that too rigid? Is that too rigid of a time frame?
Yeah. Well, everything about this is completely rigid. It doesn't take into account how conservative are you? How afraid are you of running out of money? Do you want to leave a legacy? Are we going to include Social Security? Are we going to are we going to live longer, live shorter? There are all sorts of different things that it doesn't take into account. So it's a very rigid system. It kind of reminds me of going and buying a suit. I've never been able to buy one off the rack and have it fit. It has to be customized. Every client is different, as you said, and we want to make sure we have a tailored plan for them and not just rely on something off the shelf.
So, Chris, as you well know, I'm an instructor at the Exit Planning Institute. I teach on finances and building business owners for exit planning, and we teach other professionals nationally. I think in the last two classes, we've had over 400 CPAs, attorneys, financial advisors who have been underneath our tutelage, especially impacted by heritage investors. Right. And one of the things that we look at is business owners. They often have this asset, this business over here, while at the same time we're trying to teach them that they can save some money outside of their business. In fact, they should for diversification purposes. Yeah. And we often say, we've got this 4% rule here that we try to generically just throw out as a moderate, I would almost say a conservative number when it comes to projecting some numbers. However, there's this methodology that always bothers me, and that's called sequence of return risk. I've written papers about this. You've written papers about this. Yours are a lot better than mine are, by the way. But we both have written papers about the sequence of return. I think it really plays key into what we're talking about, this 4% rule. Can you explain for the audience what is sequence of return risk?
Absolutely. So sequence of return is if you are not adding to your portfolio or taking money away from your portfolio, whether the market goes up or down early in your investing career or late, it doesn't matter. But when you are either adding money or taking money away, we're focusing more on retirement, because once you retire, that portfolio is pretty well set. You don't have any more income. You're not adding into it. So if you have a big market drop in the first, second, third year retirement, that is a big deal, because if you continue to take out of that portfolio at much reduced asset prices, that's gone. It doesn't have an opportunity to come back in a future rally. So the sequence of return is you end up having the ability to spend more money or pass along more money as a legacy if you have a market drop in year 25 of a 30-year retirement, not in year 2 or 3.
So let's put some meat on that bone. Let's say this year we had some clients who retired in January of this year. I mean, all things looking good. They were moving pretty well. I mean, as of February, I think it was 19th, we hit an all-time historical high in multiple sectors of the marketplace.
Yeah.
And then all of a sudden we're down in some indexes. I mean, we're down 60% within about a 3, 4, 5 week period, depending on which index we want to talk about.
Right.
And these retirees who have this fixed portfolio, let's assume, in fact, one of them did just sell a business. They took the liquid assets, threw it in the portfolio. Now they're going to start spending this money out of this portfolio for the rest of their life. And here we are now, the portfolio's dropped 20, 30, 40%, depending on the particular hypothetical illustration that we're talking through. So with sequence of return, if I put the meat on the bone, so to speak, would sequence of return say that by us taking dollars out of that portfolio now, when the market is 20, 30, 40% down, it actually is robbing or harming us on the longevity of that portfolio long-term? Is that kind of a simple man's way to say it?
Yeah, that's a simple way to say it, because right, over the long term, the market does well. There are short-term drawdowns, and that's why as advisors, we're constantly telling our clients, invest within your risk tolerance, because when the market goes down, if you pull it out, that harms you for 10, 20, 30 years. So that's exactly why. You know, if you're unlucky enough to have that down market early in your retirement, that'll constrain the amount of funds that you'll have for yourself or your heirs.
So there are some dangers though in this 4% rule. As if we look back, we have say this is a good rule of thumb. We look and say this is measuring a long term, and not everybody has long term like my father didn't. Some people have longer than this 30-year time frame. We're looking at the portfolio, as you mentioned, is various. Some people are aggressive, some people are more conservative. We're basing things on historical returns. In fact, I've ran one scenario, Chris, where I took the last 30 years and ran it through reverse. Just took it and mirrored it, and it just sucked backwards, right? Going forward, it was really nice. Going backwards, it was awful. So we're not looking at, we do know that past performance is not indicative of future results, and any assertion to the contrary is a federal offense. We know that. But then we get into this idea that, is it a good general rule? In fact, Professor Wade Pfau of the American College has come out with some information here in the last little bit that perhaps challenges this 4% rule. So I'd like to unpack that and then kind of bring it 360 to, okay, if it is not a good rule of thumb, then how should we plan? So let's talk about what Wade Pfau has, the professor at American College, which provides a lot of our credentials in the financial world. What has he discovered?
I just saw an article that with interview with him where he said, if you're a conservative investor, it's a 2.4% rule, not a 4% rule. He's cut it almost in half. And there are two reasons why. Number one, where are bond yields?
Oh, yeah.
80 basis points on a 10-year?
Yeah.
That's insane to me. So you only have to go back just the last decade. The prior decade was about 2.4% yield. The decade before that, it was almost 6% yield. The decade before that, almost 10% yield. That gives you a nice basic cushion for your portfolio, especially if you're conservative and you're holding 40 to 50 or even 60% in bonds. Right now, that's awful. The other thing is there's no one way to value stocks. We all know that. But the Shiller PE, which looks at trailing 10-year inflation-adjusted earnings as the E for the price to earnings of the market, we're at about a 30 level on the Shiller PE, which is pretty significant in terms of fully valued.
Okay, so let's
Very,
unpack
very,
that. That's a lot of technical talk right there, Chris. Okay, so let's get back. The Shiller PE. PE stands for what?
price to earnings.
Price per earnings. Shiller
Really,
was an individual, I'm assuming.
yep.
Okay.
So price to earnings is, how much do you have to bid up the price of a stock to own that earning stream, that future earning stream. So when
Can you give me an example of that, Chris?
Sure, exactly. Whether stocks pay dividends or not, they're pretty much are valued according to their earnings. I love the expression that in the short run, the market is a voting mechanism. You vote for what you think is going to do well in the next little bit. In the long term, it's a weighing mechanism. What it weighs is the earnings of those companies.
And the earnings ultimately is just another way to say the profits of the company. The stock market's basically looking forward and saying, we think that XYZ company stock out there is going to have a profit of 4, 5, 6, 7% of their base revenue. And then the earnings are actually comparing what the forecast or what they projected to actually what actually happened. Is that a simple way to describe that?
Exactly fair. And it's based on the growth also. You don't expect if they're earning 100,000 earnings today, that will stay the same. You project that out. Oh, we think that they'll grow their earnings at 5% or at 7%.
So with the Shiller PE ratio being relatively high,
correct.
Okay, if I hear that in my financially simple terms, I would say, well, would we want the ratio to be really high? I mean, that means the companies are making a lot of earnings. I don't think that's correct, is it?
It means that you're paying more for those earnings than you did before as an investor. We like to invest. We don't want a bear market, but we like to invest when stocks are cheap. We don't want to buy in at a very high level because that constrains what we earn down the road.
So the higher the stock price today relative to that earning ratio means there's not as much runway, there's not as much potential upside pressure, upside movement of that particular equity. Am I correct in that?
That's correct.
So basically, Professor Fowl is saying, if I'm saying his name, Fowl, I think, he's basically saying two different things. The first one is that interest rates are pretty low right now, relatively speaking. We're not getting that much return on the conservative assets, historically speaking, when we're looking at fixed incomes. The second thing he's saying is that the stock market just doesn't have a lot of headroom based on the ratios. Am I saying those two things accurate, Chris?
Exactly right. Based on history and things can change, but given that long-term history, we're really at towards the very top of the expensive range in stocks, not the very bottom of the more cheap range of stocks.
So what does all this mean, Chris? We're dealing with people in the real life, and they're sitting here going, okay, you guys have talked a little bit of Wall Street jargon here today, and we're trying to help you understand. We've got business owners of every different stripe and culture and creed out there right now, running every different type of business you could think of. And I could just hear one particular client as he's going to listen to this saying, Justin, I'm a ditch digger, man. I want to sell my business in 2-3 years for XYZ. Am I going to be okay? Can you look me in the eye and tell me I'm going to be okay and I can do that? Is that what the ultimate reason for this conversation is?
At the end of the day, retirement is the biggest financial decision you're ever going to make.
Yeah.
Do you really want to rely on a rule of thumb rather than a detailed financial plan? There are times where we can go out and wing things, right? And do okay, but the stakes are so high on this. The thing that really shocked me looking at this paper that Wade Fowl was a co-author of, given where we are with that pretty expensive stock market and extremely low interest rates, for a 50-50 portfolio, the chance of success, a 4% withdrawal over 30 years, 30%.
Whoa.
So let's not rely on that rule of thumb. Let's do a detailed plan and let's look at what your spending is likely to be, what you have coming up. Let's look at other ways to kind of give you more income in retirement, because we retire on income, not on assets.
You know, Chris, you and I have had these meetings. We've in our careers, we've looked across the table from people, hardworking Americans who have spent their life pouring into businesses, who spent their life trying to save up their nest egg. And ultimately, whenever I sit in these meetings, the times when I get nervous sitting in the meeting, and I don't do this often, but it's whenever the client looks at me and they say, Justin, am I going to be okay? And that's a very valid question that people pay us lots of money to answer.
Right.
And whenever we're running all of our planning and all of our different algorithms and all of our different market scenarios, everything that we are fiduciaries to do, Chris, we ultimately boil it down to answering that one question at the end of the day. Are you going to be okay? I remember whenever my dad was disabled, he looked at me and he said, son, are your mom and I going to be okay? And I said, yeah, we're going to be okay, Pops. We're okay. We've done the planning right. I remember whenever my dad passed away unexpectedly, be able to look at my mom and say, Mom, you're going to be okay. We did the planning right. I've had that conversation memorialized in my mind, Chris, some 3 or 4 times in my career where I looked at the client at the moment of concern, whether it was before transaction for them to actually pull the trigger for retirement or after the loss of their loved one or right before they sell their business. And when we calculate it through our advanced technologies, we ultimately come down to this type of scenario saying, what specific results do we have to have? And what's the probability of success? Man, I got to tell you, Chris, if I had to look at somebody and say, there's only a 34% probability that you're going to be successful, I'd have a hard time with answering yes on that one.
Absolutely.
You know?
Absolutely. It's shocking.
Yeah, it's scary actually. So as we bring this plane to the ground, I like to use my aviation terms with our pilot here, who's all the time trying to educate me on the finer things of avionics. The question is this, Chris: 4%. We talked a lot of technical stuff here, real quick.
Yeah.
The average person's not going to remember this. Heck, I don't remember it half the time. Whenever I'm dealing with it, I have to go back and refresh my memory on what's the Schiller price per earnings ratio and I passed a test on it, but what exactly is that, right? What's the end of the day result? Why, if as we title this particular podcast, how should business owners adjust their plans given the dangers of the 4% rule? How would you answer that?
The quick answer is you got to work with the planner. You got to, we'll keep it on the straight and narrow. Again, I delved into the Trinity study, the Bengen rule, all of these variations on the academic research based on the 4% rule that you don't want to get into. And there are aspects of what you do I don't want to get into. If you're a business owner, you really want somebody who can advise you, who has done the research and can put you on the right path. It's been proven through so many studies that you do better financially, but also just feel better, sleep better by using a financial advisor. So that's my advice. Don't rely on a particular rule of thumb. Like anything else, put the effort into hiring a team of experts, and that'll get you to the finish line.
And friends, if you find yourself saying, man, this is a lot of technical information, join the crowd. Join the crowd. You know, Wall Street often gets a bad name. I like to give them a bad name sometimes, but as business owners, we do have to, unfortunately, have to know some of these technical terms before we make a decision. And as Chris said, if you find yourself saying, man, guys, I don't understand what you just said, but I don't want to fall in a 30% probability of success. I want to be in that 90+% probability of success as I enter retirement. The sooner you start planning, the better it is. If you have any questions, reach out to the team. You can find us on financiallysimple.com/work with the team. It's actually on the Financially Simple. You can go to Heritage Investors. If you have any questions for Chris, I'm telling you, he's wicked smart. He can walk you through some of these technical things. Say, hey, Chris, I just want to pick your brain for 15 minutes. Do us a favor. Call the office here, 865-690-1155, and our team will hook you right up with Chris, and he'll jump on the phone with you and say, sure, man, here's what you should do. At the end of the day, we're going to quantify everything, the advice that we give to our clients. We're going to quantify it. And I got to tell you, friends, we have a brain trust of really, really, really smart people. I'm probably the dumbest one of all of us. There's some really smart people here that work as colleagues of mine. And these guys and gals on this team of Heritage, they are powerful and they deeply care about serving you, the customer, and the client. So with that, look, friends, life is tough. Life is tough. We're dealing with some very interesting things in our country at this time. Life is tough, but life is good. Life is good. You might have, I might not be sunburned next time. We're going to check that out whenever we go on the video. I got to figure out why they've messed my lights in here. I started laughing. They're over here laughing at me, by the way, right now. So yeah, we made you look funny on camera. So y'all give him a hard time. You reach out to Mr. John and say, that was awesome, John, on the video on YouTube. Life is hard. Life is tough. But life is good. It can be frustrating sometimes, but money doesn't have to be. Hey, look, Chris and the rest of the team here is here to make your life at least financially simple. Y'all go out and make it a great day.